Chapter number 2, Accounts of Not-for-Profit Concerns. Let's understand the meaning of not-for-profit concerns. Not-for-profit concern is that concern which is not started for profit motive but to provide services to its members or society. What kinds of services do these not-for-profit concerns provide? They provide services such as sports club, charitable hospitals, schools, colleges, universities, trade unions, Chamber of Commerce which operates for issues related to various businesses, professional institutions like we have the ICAI, the Institute of Chartered Accountancy of India. Then we have various trusts which operate to provide social service, social welfare associations, religious concerns, libraries, etc. These are few examples of not-for-profit concern. If these services do not work for profit motive, then why do they provide these services? So they provide services as their main aim is to provide social service and to promote art, culture, sports, education, etc. Also, even though these concerns do not work for profit, but yet they have to maintain their books of accounts. But why? These concerns mostly deal with public money, which comes in the form of subscriptions, donations, grants, entrance fees, etc. Hence, they are answerable to the public with regards to the various sources of income, that is, in which all ways they have received income, and the heads of expenditure, that is, for what all purposes the money is spent. Maintaining books of accounts will also help the concerns to know whether the income they have received is in surplus or in deficit compared to their expenditure. The public can also know about the net worth of the concern. Net worth means the value of the concern, which can be determined by deducting the outside liabilities from the assets of the concern. The concern can also keep a track on about any malpractices or misappropriations taking place with the cash or any other assets of the concern. The accounts that are maintained by a not-for-profit concern are the receipts and payments account, the income and expenditure account, and the balance sheet, which is a statement. These together are called the final accounts of a not-for-profit concern. With this information, let's take a quick comparison between a profit organization and non-profit organization. Profit organizations are also called as trading organizations. Non-profit organizations are also called as non-trading organizations. Profit organizations' main aim is to earn profit, whereas non-profit organizations' main aim is to provide service. Profit organizations prepare trial balance. We have studied a trial balance in the 11th standard as well as in partnership final accounts, whereas non-profit organizations prepare receipts and payments account, which we will be studying in detail in this chapter. Profit organizations maintain trading account, profit and loss account, and balance sheet. Non-profit organizations maintain receipts and payments account, income and expenditure account, and balance sheet. As I mentioned, we'll be studying these three in detail. Profit organizations either earn a net profit or a net loss. Non-profit organizations either have a surplus of income or deficit in income. Profit organizations' capital fund includes capital plus the reserves, whereas for a non-profit organization, the capital fund includes all the amount that has accumulated through entrance fees, surplus, legacies, specific donations, etc. These terms are all new for you. We'll be studying them in detail as we proceed with this chapter. So with these details, let's get into the accounting in not-profit organization. For short, we call it as NPO. So the day-to-day transactions in an NPO are recorded in either a cash book or in ledger accounts. Both of these we have studied in detail in the 11th standard. At the end of the year, the cash book and ledger accounts are closed and the receipts and payments account is prepared. Receipts and payments account is therefore a summary of all cash and bank transactions of an NPO. Receipts and payments account is a real account. In the 11th standard, we have studied the rule for real account, which states that debit what comes in and credit what goes out. So what comes in the NPO, we write it to the debit side of receipts and payments account, and what comes in is the receipts. Similarly, what goes out of the NPO, we write it to the credit of receipts and payments account, and what goes out is the payments. These receipts and payments are irrespective of the period for which they are received or paid. That is, they would be received or paid for the previous year or the current year, that is the ongoing year, or for the next year. Throughout the year, whatever amount is received is written to the debit side, that is the receipt side, and whatever amount is paid is written to the credit side, that is the payment side. However, any kind of income that is receivable which is not yet received and would be received sometime in the future, and any kind of expenses that are not yet paid but are payable, which would be paid sometime in the future, so such receivables and payables do not find any place in the receipts and payments account. Only income that is already received and expenses that are already paid are recorded in the receipts and payments account. Receipts and payments account includes all revenue and capital receipts and payments. Let's quickly understand revenue receipts and payments and capital receipts and payments. So revenue receipts and payments are recurring in nature. Receipts will take place several times in a year. Payments will be made several times in a year. Examples would be interest that could be received on investments, maybe every month or after every 3 months. Insurance premium which would be paid quarterly or twice a year. Rent that would be received every month. Electricity charges that would be paid every month, etc. These receipts and payments are made several times in a year. They are recurring in nature and they are called as revenue receipts and revenue payments. On the other hand, capital receipts and payments are non-recurring in nature. Once the income is received or payment is made, the benefit of such would be received for a long time. Example, specific donations which would be received for a specific purpose, like donation would be received for constructing a building or for organizing a tournament. Next example, purchase of fixed asset, like maybe a motor vehicle which is purchased only once and its benefits for the organization are for a number of years. Life membership fees which would be received only once, etc. So these receipts and payments are non-recurring in nature. Let us now quickly go through the specimen of receipts and payments account. So to the debit side, we have all. So let's have a quick look on the receipts and payments account. To the debit side, we have all the receipts, and to the payment side, we have all the payments. As we begin with the receipt side, we have to the debit side the balances of cash and bank. The balance from the previous year of cash and of bank, these balances have been brought forward in the current year. So after the balance is brought forward, the next balance that we have to the receipts and payments account is that of subscriptions. Now subscriptions, they are an income, they are given to the receipt side, which means that this is the amount of subscriptions which has been received during the current year. Subscriptions are basically membership fees paid by the members on regular basis to use the facilities provided by the NPO or whichever club, like the sports club, library, etc. Below subscriptions, we have been given the balances of subscriptions for the previous year, the current year, and the next year. So as I mentioned earlier, all the receipts which are given to the receipt side are irrespective of the year for which they are received. Suppose cash is received, no matter for which year it will be received, it is written to the receipt side. Next to the receipt side we have is the entrance fees. Now entrance fees, it is the amount which would be received from anyone who intends to be a member of the NPO. Then we have the admission fees. It could be any amount of admission fees which would be received by, for example, an educational institution. Then we have the life membership fees. It would be the amount which would be paid by member once and for all the years to come. The next income or receipt which we have is the legacies. Now legacies are similar to donations. They would be received, however, as per the will of a deceased person. Now following this we have government grants. It would be any aid which would be received from the government. Next we have the donations, general donations, as in the amount would be just given for any purpose the NPO wants to use, the amount can be used. Then there are some specific donations, like somebody may give a donation and say it would be used for the building, or it may be used for any kind of prize that the institution, the NPO wants to give, or to hold any kind of tournament. We further have to the receipt side all the other receipts in the form of dividend. If the club or the NPO has some hall which would be given on rent or on hire, then the amount would be received. Sundry income, sale of old material, sale of paper, scrap, any kind of miscellaneous other receipts, any tournaments which are conducted for which receipts would be for which income would be received. Cricket fees may be received by a sports club, tuition fee by an educational institution, term fees, collection of fines, locker rent, when lockers in a club may be given on rent has to be paid for these lockers, exam fees. So these are the receipts that we come across in the receipts and payments account. Now when we move on to the payment side, on the payment side, if there is a balance brought down mentioned on the payment side, then it means that it's a credit balance and the bank is running in an overdraft. That would be the amount of bank overdraft. Then further to the payment side, we have various expenses, like in our example over here we have salaries that are given to us, salaries which are given. Now over here also salaries which are paid for the previous year, they are paid for the current year. There could be expenses which are paid for the previous year, current year, next year, as I mentioned earlier on, irrespective of the year for which the expenses would be made, payments would be made. Further, we have expenses like printing and stationery, general expenses. All these we have come across. The receipts, most of them, and the payments, mostly all of them, we have come across all of them when we have done the chapter partnership final accounts, interest on bank loan, audit fees, tournament expenses, purchase of sports material. If it's a sports club, they may have to purchase sports material, bank charges, all of this, postage, conveyance, expenses for annual function, fixed deposits. If the deposits have been purchased in the current year, or any kind of fixed assets may have been purchased in the current year. Payment is made, so they are written to the payment side. Furniture is purchased during the current year, building is purchased, investments are made during the current year. That is the reason why they have been mentioned to the payment side. The newspapers would be purchased, or any kind of office expenses. So all these are the examples of payments that will be made during the current year. Now when the receipts and payments account is closed, suppose when the receipts and payments account is closed and we have a balance carried down to the debit side, that is, we have a to balance carried down. This is a credit balance. When we are talking about receipts and payments, I've mentioned earlier, receipts and payments account is a real account. Real accounts always have a debit balance. However, in this case, if the receipts and payments account has a credit balance, then it means that the bank account is running in an overdraft. And if the receipts and payments account has a debit balance, that is a buy balance carried down for cash in hand and cash at bank, it means that the bank has a bank balance and we have cash balance in hand as well. So this is receipts and payments account in short in front of us. There would be many more examples for receipts and payments account which may not have been mentioned here. We will discuss them as and when we come across them while we solve our problems. The next account maintained by an NPO is the income and expenditure account. Income and expenditure account is a summary of all revenue incomes and revenue expenses. Revenue incomes, revenue expenses are those which are recurring in nature. They may be received or paid several times during a year. Income and expenditure account is a nominal account. The rule for nominal account: debit all expenses and losses and credit all incomes and gains. So to the debit of income and expenditure account, we have all the expenses and losses. That is, in this case, we will have all the expenditures. And to the credit, we have incomes and gains. So we have the income side as the debit. This is similar to the profit and loss account which we have studied in the chapter Final Account. Debit all expenses and losses and credit all incomes and gains. These expenditures and the incomes are all of revenue nature and only of the current year. So any expenditures of the previous year or the next year and any incomes of the previous year and the next year will not have any place in the income and expenditure account. So all the expenditures and all the incomes only of the current year and of revenue nature are recorded in the income and expenditure account. Now, after recording all the revenue, expenses and incomes of the current year only throughout the year, then the income and expenditure account would be closed. On closing the income and expenditure account, suppose the incomes are in excess of the expenditures, then it is called as a surplus of incomes. If the expenditures are in excess of the incomes, then it's called as a surplus. This surplus is the credit balance of income and expenditure account. It will be added to the capital fund in the liability side of the balance sheet. And the deficit, which is the debit balance of income and expenditure account, would be deducted from the capital fund to the liability side of the balance sheet. With this information now, let's have a quick look at the specimen of income and expenditure account. So to the expenditure side, we have all the revenue expenditures of the current year only. And to the income side, we have all the incomes, revenue incomes of the current year only. What I mean to say is that the amount of expenditures in the outer column and the amount of incomes in the outer column will be all for the current year only. So any expenditures, any incomes of the previous year, of the next year, we will have to minus them. Let's see in detail, and we will begin for that matter from the income side here. So to the income side, we have the first income as the subscription received. Now, subscription received, there is something below subscription received also given to us. I will just highlight this and we will see it in detail. So for subscription received, what is mentioned below is there is something that is deducted, that is we have minus, we have less. What have we less? That which is received for the last year and that what is received for the next year. So as I mentioned to you, the amount of subscription which will be in the outer column will be the amount of subscription received only for the current year, received or receivable, but pertaining to the current year. And that is the reason why the subscription for the last year, that is the previous year, and the subscription for the next year are all deducted. Then on the other hand, there is some amount of subscription, some additions made to the subscription. What addition is this? This is the amount of subscription which is received during the last year, but for the current year. The amount of subscription which was received during the last year means it was received. Current year subscription which was received in the previous year, last year. It is pertaining to the current year, so we add it. And also what is added is the amount of subscription which is outstanding for the current year. So that amount of subscription which is outstanding receivable for the current year, it is pertaining to the current year, so it is added. So whatever is for the previous year or the next year is all deducted, and whatever is for the current year, pertaining to the current year, is all added. Let's have a look at the other examples on the income side. As mentioned earlier, income and expenditure account, it is similar to profit and loss account. So the incomes which we have otherwise come across in our profit and loss account would be similar and would be mentioned, repeated here. So the other incomes which we have are the rent received, interest received, dividend received, government grants received, ground rent received, sundry receipts, entrance receipts, entrance fees. We have seen the meaning of entrance fees when we did in detail the receipts and payments account. The other incomes would be admission fees, donations, profit on sale of asset. Then we come to the expenditure side. So like we had in the incomes, to the expenditure side also there are expenditures mentioned with some additional information. Like for example, we have salaries here, and below salaries there is something more, some more information given with respect to salaries. So let's have a look at this. Now below salaries, there is something that is deducted from salaries. We have less something from salaries. Now what is it that we have deducted? So this is that amount of salary which is paid for the last year, that is the previous year. It is not for the current year, so it is deducted less. Then there is salary paid for the next year. It is not for the current year, so naturally it is again deducted. Then there is some amount of salary which is added. Now which is this amount of salary which is added? There is some detail which is missed out over here. It is that amount of outstanding salary for the current year. It is for the current year, so it is added. And then there is more something added which is prepaid during the last year. It is prepaid during the last year means it is for the current year and was paid during the last year, that is previous year. So all for the current year is added, all that is not for the current year is deducted. So we have the amount of salaries only pertaining to the current year. Then the other expenditures which we have and we have come across in our final accounts. So we have wages, printing and stationery, rent, interest, conveyance, insurance, office expenses, telephone, mobile. Very specifically, you have to keep in mind the expenses with regards to medicines, with regards to sports sports materials and also with regards to printing and stationery. There is something very important about these three expenses. What is it that is important? That we will see now. So if we see for sports material, again there is some additional information here. What is this additional information with regards to? So for printing and stationery, for medicines and for sports materials, the amount which is mentioned in the outer column is the amount which is consumed during the current year. Here it specifically mentioned for sports materials, and the amount of sports materials in the outer column are the sports materials consumed during the current year. Now how do we derive this amount? Simply speaking, let's first find out what we had with us. So what we had of sports material is the opening stock. That is from the previous year, some balance sports material that we had balance with us. Plus during the year some sports materials were purchased. So we have, this is the amount of sports material which we had during the year. And out of this balance sports material is the closing stock. This is the balance sports material that we have with us now. So opening stock plus purchases, from there we minus the closing stock, that is what is balance with us. We will get the amount of sports material that was consumed during the year. Likewise will be for medicines. Opening stock of medicines plus the purchases of medicines during the year. And we minus the closing stock of medicines. We will get the amount of sports medicines which were consumed during the year. So the formula goes opening stock plus purchases minus closing stock. We will be solving several problems based on this formula. And further we have the other expenditures, that is repairs and maintenance, electricity charges, newspapers, sundry expenses, depreciation, all of this. Now in the end, when the income and expenditure account will be closed, suppose, as I have mentioned earlier, the incomes are more than the expenses, that is the incomes are in excess of the expenditures, then we have a surplus of income over expenditure, and it is also called as the credit balance of income and expenditure. On the other hand, if the expenditures are in excess of the incomes, then it is called as a deficit, and it is the debit balance of income and expenditure. This surplus, then it is further added to the capital fund. So we go to the balance sheet. So we have the capital fund, which we usually always had, and we have been seeing this and solving problems based with the balance sheet. So we have the capital. If there is a surplus, the surplus, it is added to the amount of capital. On the other hand, the deficit which we come across, it would be deducted from the capital fund. It's just like net profit. Then in the balance sheet further, we will see there are several additions which are made to the capital fund. This is nothing but as and when it is mentioned in the question about capitalizing a particular balance, then we will be capitalizing it. It is mentioned in the question, capitalized donations, capitalized entrance fees, then they are added to the amount of capital fund. Further to the liabilities, we have building fund, endowment fund. So all funds we write to the liability side, special fund, charity fund, and then we have the other liabilities also, which we have come across several times. To the assets, we have all the assets which we have been coming across as we solved the partnership final accounts and even the sole trading final accounts in the 11th standard. So balance sheet will be almost same what we have been always preparing, with a minute difference about capitalization of certain incomes and the addition of surplus and deduction of deficit. So that's about the preparation of accounts of non-profit organization. So the accounts maintained by a non-profit organization would be receipts and payments account, which we have seen in detail, income and expenditure account, and the balance sheet. Now in the question for an NPO, receipts and payments account would be given with adjustments, and we would be preparing the income and expenditure account and the balance sheet in our solution. So all these three accounts comprise the final accounts of a not-for-profit concern. So that's about it. In the next video, we will be doing the adjustments with regards to final accounts of a not-for-profit concern.